Ladies and gents, it's Simon Brown here. Before I do intros to our speaker, I just want to confirm that you are able to see Keelan's screen and that you're able to hear my voice. If we get yays to both, brilliant. Hands coming up already, digital hands flying. We are winning in that regard. We will take questions, so if you've got questions, drop them in the Q&A box. We'll pick up on the questions at the end of the presentation. Keelan does leave some time, but we will grab those at the end. I don't want to interrupt as he's going along, so we'll grab those at the end of the presentation. Ladies and gents, evening. My name is Simon Brown from Just One Lap, doing the introduction this evening for another JSE Power Hour. And we are truly honored to have Keelan Ndlovu back presenting for us. He comes and talks property every year at about this time at a Power Hour. He's the absolute knowledgeable expert of listed property out of Stanlib. He talks local, he talks global. He'll give us insights and thoughts around it. But with that, Keelan, I'll hand over to you.
Good. Thank you, Simon, and thanks to the JSE for the invites over the years. Yeah, this time is different. We're doing it online, so you can't see the people. So that's the new times that we live in. So it's been quite a tough period, as all of us have experienced it. And we'll touch on, start with the local market and then move on to the offshore markets. So talk about the SA listed property sector. So most of you quite familiar with, it's the assets that we see as we drive around, go shopping. So you'll probably relate to most of the issues we're going to talk about. So it's a market that's been the darling of the JSE with superior returns over the last couple of years. But the last probably 2 to 3 years, things have changed and they've actually become worse, as we've seen so far this year. So what the slide shows, it shows the total return so far in 2020. So the numbers are up to end of September. We've seen the sector fall by almost close to 50%. So the biggest decline was in March. So one thing to point out there is that the property sector was already declining before COVID-19. And then COVID-19 came with level 5 lockdown. So that huge actually decline in the property prices, and then some recovery as you go along, people thinking maybe COVID's ending, and then moving to level 3 or level 4, and the sector falls again. So it's been very tough. So you can see 2 indices at the bottom there. You've got the SAPI, that's the SA listed property index, and then the ALP, that's the all property index. So all property index basically includes the UK, and it suffered more mainly because of the UK stocks like Intu and Hammerson falling quite sharply. So that's year-to-date returns. And if you look at over time, as you can see, you've highlighted property in red just to make it more visible. For year-to-date, down 46%. Over the last 12 months, down about 46%. Even if you look further, let's say over 5 years, 10 years as well, the returns haven't been very exciting. Over 10 years, only 1.8% annualized returns. Now, let's point out that this is mainly because of this year's negative returns and 2018 to a certain extent. But this year is actually tracked down basically everything, and property has delivered more like cash returns on an annualized basis over the last 15 years. So the big question is where to from here. So what has happened? What caused property to fall by that kind of level of magnitude? So what you can see all these words: discount, rental deferrals. So this applies to the discounts offered by the property industry group, which were anywhere between 55 to 100%, and that applied mainly in the retail space, and to a certain extent in the office market and in the industrial sector, but on a case-by-case basis. So with these kind of discounts from level 1 to level 2, that's quite huge. So they do have an impact on earnings. That's why the market looks first, okay, the earnings are going to come down, I'm going to get lower distributions. That's why we saw the sector fall quite a lot. We'll touch more later on as we go more into the retail space to see that impact on these property companies as well as trading. So that's assistance provided to the tenants by the property landlords. And then on the other side, what was provided to the property landlords or the listed property companies? So it's been quite a big topical issue over the last couple of months. that property companies wanted some sort of relief as well. But what they got through the JSE and FSCA was basically 2 months extension to pay out distributions. So previously they had 4 months, so within your year end to pay distributions. And just give you an example, let's say if you had a June year end, you had up to end of October to pay out the distributions or dividends to investors. But now that's been extended by 2 months to say December, which is good because it gives you time as well to follow up or chase maybe your tenant who you deferred rent to give you some rent over time, and then you can pay it out to investors as distributions. So that's not probably the relief that property companies were looking for. They wanted more from the National Treasury and SARS, like tax relief or tax dispensation. So I put that as yet, or kind of brackets, that probably more unlikely if we are to be honest, given the challenges the economy is facing and what's going on. So property companies have to pay out at least 75% of their earnings to investors as distributions, whereas previously during the good times they'll pay out 100%. But now they need to retain some of the income just to help mainly with the debt levels which have been actually spiking. I will show you in the next few slides. So you will see payout ratios coming down from 100% to probably 75% basically across the board, apart from 1 or 2 strong companies. So why is that? Is that before, property companies didn't have to retain income. They could go to the equity market through book builds, through rights issues, and say they need money from investors. And investors were happy to give property companies. If you look at 2014, the property sector raised almost 70 billion rand in new money. And that's been trending downwards. And we're saying in 2020, we're looking at about 6 billion, there about 7 billion maybe. That was mainly because of the equity raised at the beginning of the year. So the balance will come from property companies doing dividend reinvestments. As opposed to getting cash, you opt for shares at a discounted level. So that's why I find that that's dried up for property companies. So that's option 1. Option 2 is if you can't raise equity, you sell assets. And we're seeing more and more property companies or REITs on the market trying to sell some assets. But it's quite challenging at times to find a buyer at the right level. And at times you may have to help the buyer as well with vendor financing as well to be able to sell some of your assets and use some of that cash to pay off our debt. So the last resort for property companies is to retain some of their income, and that's about 25%, which is taxable, unfortunately. So why are they looking to retain income? This is the biggest challenge now because fundamentals are weakening. Your rental income is actually slowing or even going negative in most instances. And so valuers will look at that, look at the prospects of these property companies, and so those assets are not worth the same level as before. So these are the recent results, looking, let's say, from left to right. On the left-hand side, the companies that suffered the most was hospitality, which owns hotels, and no one's been going to hotels or traveling or domestic tourism, and you see those assets being written down. And then capital and counties in the UK, that's Covent Gardens, less tourists in London, less people going out, eating, dining, so that's affected those assets. And then L2D, that's Sandton City, that's Eastgate, that's Melrose Arch, all actually taking a knock in terms of valuations. On the right-hand side, you can see Napier Castle, that's Eastern Europe, sort of been one of our favorite companies. We've only seen a marginal decline in valuation of about 3%. SA Corporate, mainly because of their residential exposure, has been fairly probably defensive, as well as an industrial portfolio. And Resilient, the name just says Resilient. They've got good assets dominant in non-metropolitan areas, townships, rural areas, and those have held up even during our lockdown. But it's not like this has happened recently. The valuations have actually been coming down, and the retail sector is probably seeing probably the biggest knock. So this chart shows cap rates or capitalization rates. So as cap rates go up, your physical property values come down. And you can see whether it's the industrial sector or the office sector or the retail sector, all the sectors have been feeling that pain in terms of valuations coming down. And that's being worsened by COVID-19 this year, and that's likely to continue even into 2021. So we'll probably see about 10 to 20% decline in physical property values across the sector in general. So then we come to this topic that what happens now? So say values are coming down, what are the banks going to do? So what this slide shows you, just for your information, you can see that on average, property companies, their debt covenants sit at about 50% in terms of loan to value ratio. That's your left-hand column. And then on the right-hand side, that's your interest coverage ratio. So a typical acceptable interest coverage ratio is 2 times, 1.5 times some instances, but you want it above 2 times. And look at the sector on average, it's about 2.7 to 3 times, which means it's still in a comfortable space to pay out interest to the banks. That's the ability to pay out interest. From an LTV perspective, the average LTV for the sector right now is about 41%. So for the sector to get to the 50% levels where you start breaching debt covenants, you probably need to see property values decline by about 20-21%. But that's on average. So what I've done here is just to show you, let's look at individual companies, because we can't just average everything. So what you can see here is that on the right-hand side, EQU, that's equities, they'll need values to decline by 45% for them to get in trouble or to be negotiating with banks. Growth point about 37, resilient 33. On the left-hand side, it's high prop. It depends how you look at it as well. If you fully consolidate their offshore exposure, then they probably need to talk to the banks now. If you look at it on a see-through basis, there's still about 18% to go. So it's one thing you have to watch out when you look at these property companies, that some are more defensive than others. Some may have to raise probably equity or cut distributions to adjust to the appropriate LTV levels. So where do you see LTVs going to? So as I mentioned earlier on, the current LTVs for the sector, they've moved from 37% to 41%. And you see that number still going upwards and peaking out about 2022. So this number could be higher, assuming that if property companies reduce their payout ratios, didn't sell assets or raise equity. So in these numbers, we're factoring in lower payout ratios, disposals, to help actually reduce that LTV to not to go above the 50% levels. And talking to some people, even banks as well, we believe they're probably likely to be accommodative when it comes to these covenants. And some of the companies are moving the covenant levels from the 50% levels to 55%. So we'll keep watching out for that. But reducing payout ratios, selling assets is key right now. And looking at the sector, so the market has looked at the prospects and said the valuations are declining, but we believe the market is overreacted to this. So the property sector is trading at about 50% below net asset value. And that's after adjusting for the recent kind of declines in property valuations, and is still down about 50%. So we don't see asset values falling by 50% over the next 2 years or so, given some of the initiatives that property companies are working on. So from this perspective, we believe that the sector is looking quite cheap, even though the outlook is uncertain. And if you look at it from differently as well, look at to see the bond market. So all along, property is probably moved in line with the bond market. So the property yield is the line below, the teal color, and then green is the bond market. So you can see in 2020, property yield spiked all the way to about 20%. That's your historic yield. So the market saying, I'm not going to get a 20% going forward. So you have to adjust for actually lower payout ratios, 25%, and then declining earnings as well. That's why property is actually, the gap is widened between bonds. It's not as safe as bonds compared to previously. That's why property market is looking cheap. So if we adjust for low earnings growth, lower payout ratios, you get to normalize yield on the property sector of about 11%, if not 12%, not the 18 to 20% levels. So the challenge is that to get to where we were before is probably unlikely compared to the bond market, because the fundamentals are likely to deteriorate further. As you can see from this slide, you've got offices, vacancies going to go up, and then on average, all property sector, and then industrial probably less so, and then retail will still expect vacancies to increase further over the next year to 2 years because of lower economic growth, less usage of space, and tenants going bust in some instances. Then talk about the office market, which has been quite topical, given that all of us are working, or not all of us, most of us working from home. So I haven't been to the office in the last 6 months, everything happening, and we're unlikely to go back to the offices until early next year. And then some of the big corporates are saying maybe they don't need the same amount of space. They may reduce by 20%, 30%. So that means over time, as leases expire, you will see less and less appetite for office space. And the challenge is that the office market vacancies were going up before. And look at a node like Sandton, before just 20% vacant, and you expect those vacancies to go above even 25% over the next year or so. And that's a challenge to landlords. So what you can see, you could P grade, that's your best office portfolios, like brand new, like your Sasol building, Discovery, that's your P grade. And then A, probably slightly older. C will be the oldest office blocks, which attract the highest vacancies. So talking about working from home, which is very topical. So what you're seeing here in terms of surveys, you find that probably half people prefer to work 1-2 days actually remote per week. So it means probably 3-day working week. And then the benefits of that is, well, people love that they don't have to commute, you don't get stuck in traffic at 7 a.m., 8 a.m. or coming back home at about 5, 6 p.m. And then flexible hours as well. So you're able to control your time and do some things that you couldn't do before and still be able to work, as well as your work and life balance. So it's very strong preference towards this remote working, flexible working, and that will change the dynamics of the office space. And we believe probably usage will fall by 15-20%. And then over time, that will increase the vacancies in the office space. So the retail sector, let's look at this slide in probably more detail, because retail sector is quite important. It's almost 60% of the property indices. So these numbers are up to end of June. As you can see, the sales, they fell about almost 11%, and most of that due to lockdown on a year-on-year basis. And then if you look at April, which is basically level 5, we saw a 65% decline in sales. So basically the tenants that are operating would be the pharmacies and supermarkets, and continue all the way to June, 30% decline. And we're still expecting probably July, August as well to be negative, and then probably improvement in September. We've seen improvements in foot counts and collection rates going up to about 70 to 80%, and then 90% in some instances. And those numbers in terms of collections, they were lower as about 50, 60%, and 40 in some centers. But then landlords have had to give some concessions. As you can see in April, almost 63% actually discounts and deferrals given to tenants, 36% in May, and then on average, you're looking at about 40%. So that does impact on the earnings growth of the property companies. You have to do this because if you lose the tenant, it's difficult to replace them, and it's actually costly as well. And in this environment, it's all about tenant retention as opposed to actually saying you move out, you can't pay the rent. And look at the different types of shopping centers. The numbers are up to end of June. And you saw like the neighborhood centers, those are 12,000 square meters or lower. That's your shopping center around you where you're going to buy bread and milk. And then the bigger centers probably less impacted by vacancies because they've got more national tenants, where the smaller ones tend to have like your boutiques and smaller tenants and some restaurants that have actually closed shop. And that's up to end of June. We expect these numbers to end of September to see that vacancies actually increase as well by another 1-2% across the board. So vacancies are increasing in the retail space. And what's also actually making it worse is that it's all this issue, people shopping online. Take a lot, open my first Take a Lot account during lockdown. I used to go shopping all the time, but now you have to change your habits, as well as Uber Eats as well. So that does affect the size of some of those centers or restaurants that need less space going forward, and then online shopping as well. If you look at like something like Checkers as well, it's not like everything that you do shop online, the store does not benefit. Because if they deliver in 60 minutes, it has to come from your supermarket close to you, and the supermarket actually picks up the sales growth. So you have to look at it actually quite carefully, that not everybody loses out from online shopping because it comes from the store. Those are the sales of the store. So looking at the online trends over time, South Africa is almost about 3% online compared to 0.2% about 6-8 years ago. And that number, we don't see it going to the US levels or China levels of 18 to 25%. There's good challenges around infrastructure, delivery, access to smartphones, people not comfortable with their credit cards, and the post office as well, and delivery is quite more expensive. And we're a much bigger country. So it's only in the metropolitan areas, more in the high LSM areas, where you're going to see that online trend pick up but not to the same levels as the other developed markets. Industrial market, we believe is going to hold up, relatively speaking, because our industrial sector has mainly been distribution, warehousing, and we're seeing more interest as well in terms of online related activities. And our favorite company will be Equitas in that space. So it's very strong, and you'll see probably more interest going into the logistics market, be it in Australia, in Europe. We've seen Investec Australia buy assets across Western Europe. And that's the trend that's going across the whole world in terms of the industrial sector. So supply, you're unlikely to see any probably new shopping centers coming up. So what you're seeing now in terms of construction activity is what was started a year or 2 years ago. Because once you start building, you have to complete it, otherwise it's going to cost you money. And then supply over time will be probably basically zero, because there's no appetite for new space or new developments at this stage. And to be challenged to let some of the completed speculative buildings. And this market, it's a tenants market, it's not a landlord's market. And how do we see the sector going forward? We'll see actually retail probably going down from about 58% to about 55% as some of these REITs, they sell their retail centers and then recycle the money, maybe going offshore or actually to help reduce the debt levels. And then office market as well, decline, and the industrial sector more interest in that space. So office market and the retail sector combined at this stage, you're looking at about 75%. That's quite big in the South African context. That's why we're seeing weaker earnings going forward, because we've got two of the biggest, the weakest sectors being the biggest exporter in our markets. And then offshore, that's a trend that's been going up over time. We're seeing just getting to about 50% over the next 2 years or so. Whereas if you look at about 2008, 2009, we had basically zero offshore exposure, and that number has gone to almost 50%, and that's helped the listed property sector. In terms of trends in South Africa, industrial sector probably going to hold up better in the short to medium term. Retail sector, you can see the decline. Office market over the next couple of years probably still going to be challenging given the high level of vacancies, and we still like Eastern Europe from a retail perspective. And then industrial across the world, big fans, as well as self-storage. So what's going to happen in the listed property space over the next probably 3 years? We're seeing companies working hard to restore their balance sheets, selling assets. Unfortunately, in tough times like this, you may have to sell some of your best assets as well to reduce debt levels. And then capital expenditure, just like all of us as well, things are tough. You don't paint your house, you probably postpone that as well. So that's a worry that you may see that companies cutting down on maintenance. New developments probably going to be suspended in some instances, and then dividends, if you can't meet your liquidity requirements and solvency, you may see companies suspending completely. So you may see 1 or 2 casualties in the property space, but the key focus to bring down LTVs. And then income levels, you'll see in this market, still actually a tenants market, and companies will do whatever it takes to maintain occupancy, even at lower levels, even with discounts as well. And then working on issues like to reduce your energy consumption, solar panels and things like that. And then what's going to happen to excess space? So still early days, think about the office market. So we think some of the space is going to be converted to with the storage of medical use, or even schools or hospitals in some instances, or residential as well. And that will happen over the next couple of years, because the space, there won't be any other alternative use. And we've seen some of the companies as well using that to do like your urban farms. So you may see somebody planting their mushrooms or in the basements or in some of the office buildings that no one's actually keen to take. So look at this chart, not so exciting, but we believe that we'll see most of the pain over the next year. So on average, property has delivered distribution growth of about 10% or so. But over the next year, 2020, 21, you're looking at about 35% decline in distribution growth. So the positive numbers of 7%, you're coming off an extremely low base with some escalations of 4 or 5% built in the leases, but the base is actually very low for 20 to 2021. To conclude on the local market, property fundamentals, they remain weak, particularly in the office sector and the industrial sector. And then there'll be trends just emerging COVID-19 with people working from home and more online shopping in some of the markets as well. And the market remains a tenants market. Landlords don't have bargaining power in this market. They'll do whatever We always get questions of consolidation. Unlikely to see consolidation given that there's uncertainty around the payout ratios, around the property valuations. So everybody's busy fixing their own problems, and you have to be quite certain how much the asset is worth before buying it. Which brings us to the property values as well. They've got so much work to do, like so many assumptions actually come up with as well. They may not come up with very actually extreme assumptions in this market, and may see some of the valuations being delayed a bit. And then global property or offshore property is about 50%. That will help actually boost returns, which are negative in the property space. Property valuations, if you look at the sector, is trading at a 50% discount to NAV. And we believe actually, despite the high focus risk, it's actually looking very cheap. And we're seeing it more like bottoming out. And we're seeing lots of inflows actually. This week, it's been positive inflows, lots of inquiries in the property space, but it's likely to be volatile. And we believe actually creates entry opportunities, but be aware that there's a high focus risk in this market. And we see over a 3-4 year basis, about 12 to 13% annualized returns and a normalized yield of 11 to 12%. So that's the local market. Then I'll move on to the offshore markets. That's the developed markets basically. Offshore markets, they fell as well. They suffered, but they recovered quicker. They're up about 40% from the lows of March, given that fundamentals have been improving, and also given that there's so many other sectors as well that you can invest in. So if you look at the right-hand side, you can invest in data centers, you can invest in tower REITs, industrial, self-storage, timber REITs, residential. Those have held up better in this market. On the right-hand side of the chart, you can see lodging and resources to hotels. Retail offices have suffered quite the most. So the offshore markets have been boosted by so many other sectors that we don't have in South Africa. All tech related, all online related as well. And self-storage as people actually is benefits from online shopping, as well as people moving houses, downscaling in some instances as well. So those are the returns that we've seen. Nice recovery coming off the offshore markets. Let's look at the long-term trends. Let me start off with the right-hand side. You can see the industrial sector over time just continue to go up. This red line. And the office market had held up, and now we see that big decline, mainly because of working from home. And the retail sector has been suffering for the last 5 years, mainly because of the industrial sector that's been doing quite well, which is all online related. On the left-hand side, we've got a couple of sectors. What you've got at the top, you see manufactured homes, which are basically prefabricated houses in the US. You can take it more like your RDP house in South Africa, where there's smaller, easy, and cheaper as well to rent. And that's held up quite well and continues to do well. Self-storage, industrial apartments as well. At the bottom, no surprise, it's malls and hotels. And over the last 3 months, COVID crisis, March, April, May, June, properties down 10%, whereas in the GFC, it was down about 35% in 24 months. So we're seeing that recovery come through. So one thing to be aware of is that property tends to overreact compared to physical property. So this slide shows the gray line, that's your physical property. So you can see when a market falls, property falls much more than physical property. We saw it in 2008 and then recovers quicker as well. In good times, overshoots the physical property market. And what we've seen in 2020, sharp decline in property, whereas physical property values have fallen, but not as much as listed property. And from a pricing perspective, global property is trading just below NAV, about 4 or 5% below net asset value. And then you're seeing actually from a price earnings ratio as well, trading more in line with the long-term average. So at these levels, still looking actually fairly cheap, more so given that we're expecting earnings growth to rebound. We're looking at about 6 to 8% recovery in earnings growth over the next 12 months. And I've seen some numbers as much as 15% increase in earnings in the offshore markets over the next year, and the yield's about 4%. And then from an earnings yield, or property yield, that's free cash flow yield compared to S&P 500. These numbers imply that properties actually has got 10% upside compared to S&P 500. So everything pointing towards positive returns on global property. And then from a yield perspective, actually we're looking even much cheaper. Because say the yield average is about 4%, and then you're looking at earnings growth being positive, but yet the gap between bond yields, so these numbers change quite a lot, but let's use this US, for example, it's probably around 1-ish or below. So you can see the gap almost 2.5%, 3%, whereas long-term average has been much, much lower. And that applies to the UK, applies to France, Hong Kong, Japan, Germany. So property from a global perspective has been oversold because of, I guess, misunderstanding in terms of sectors. Everybody always thinks that property is all about retail and offices, but there's actually much more than those two sectors. So what we've seen now is that on the physical property side, unlike in South Africa, we still expect physical values to decline. At the bottom there, you can see on the left-hand side, that's basically the US. Over the past month, you can see a 1.3% increase in commercial property values, whereas they've declined by about 9-10% over the last 12 months. And then in Europe as well, about 1% increase in property values. So why is that? It's because bond yields are lower. There's lots of liquidity. There's a hunt for yield across all these markets, given how cheap property has become. As I mentioned, it's quite interesting slide to look at here. Lots of detail, but let's say on the right-hand side. So you've got diversified sector, which is like South Africa, where some companies have got retail, they've got offices, they've got industrial. But generally, this market is more specialized. So residential is probably the biggest specialized sector at about 14%, industrial 12%. And then retail used to be the biggest a few years ago, but it's now actually number 4 at about 10%, and then offices 8%. So if we add this up, so retail plus offices in the global indices, they make up about 18%. As we mentioned, South Africa makes up 75%. So I may add a bit coming from diversified, may say on a combined basis, retail and office only about 25% globally. And I've got a choice of tower REITs, you can go healthcare, you can go hotels, you can go timber REITs, you can invest in prisons as well, and some of the energy ones. So huge diverse exposure that we have across these segments of the market. So what do we prefer in the global space? We love the industrial sector because of the growth in online retail and all this supply chain inefficiencies, and our biggest exposures with Prologis, which we've talked about over the years, and the company continues to do well. That's the US, and then you've got Goodman, that's in Australia, and then WP, that's the Belgian one, and then Segro, that's a UK one. And then now we've increased our exposure to tower REITs, data centers, biotech. Those are all the names that are popping up into our portfolios. And residential still remains one of our favorites. Mainly Germany and the US, where people rent as opposed to owning, and you're seeing ownership rates actually declining across most markets. And self-storage not only benefits just from people moving houses, it also benefits through online shopping, with facilities being as close as possible to where people live. So these are our preferred sectors, and office market very cautious on, but selective, and then retail for the big underweight. So what trends do we see going forward in the office market? Tower REITs and data centers continue to do well, industrial positive, residential probably marginal flattish, and then picks up as well. Self-storage as well, because it goes hand in hand with residential. And then healthcare, I guess, just probably all these old age people's homes, where people are concerned that all the people as well, they'll be more affected by COVID-19. And then over time, I guess with older populations, we still need healthcare facilities and retirement villages. Office market declining, but likely to stabilize over time. And then retail remains on a downward trend globally as online continues to grow. So how we positioned as a portfolio, this is the Global Property Fund, just give you a sense of how we're seeing the markets. Residential, we've got about 30% in the portfolio compared to benchmark. And then industrial overweight as well, 24-15. And then offices looks like neutral, big underweight in diversified. We've got lots of offices there as well. And then retail, you can see as well, actually big underweight position. That was as of 31 August. And then from a geographic perspective, we tend not to have big bets on regions, because one, you're taking currency risk unless you're extremely positive on the markets. We called Sweden quite right in the office sector, actually in Stockholm, that continues to do quite well. But generally, we're neutral in countries, prefer stock picking within the countries, and we are quite flexible when it comes to sector exposure. And then in the global space, the same trends as well that we're seeing. This is done by Green Street. They're looking at that the weighted number of days in the office will decline by about 15%. So that's a trend that we're seeing across most sectors across the world. And perhaps some numbers show as much as actually 3 days actually in the office as opposed to like 4 or 5 days. And that's the trend that's going to happen as well in South Africa. And so that gives us concerns about the future of the office market. But there are some industries that still actually need to operate in offices, and we're actually very selective on which companies we choose. Because if you think about the office sector, the slide, what it shows actually your cost in terms of offices as a percentage of your employment costs. Offices make up about 12%. Just to show you that office market is probably not as expensive as, let's say, the retail sector, where actually occupants cost about 53% of your employment cost. So if you're in the right office segments, in the right locations, with the industry still need to be in offices and targeting some of the big corporates or head offices where people still need to interact, we believe that there are some opportunities because the market is more than actually discounted the impact of COVID-19. So some of this may relate with as well why we need offices. It's company culture as well. We need employee engagement. People want to actually have physical meetings. In some markets like Asia, where apartments are like 20 square meters, 30 square meters, it's just difficult for people to work from home. And if you look at what I say, working from is unequal. So more senior and wealthy employees have got better facilities at home and fiber and space and study rooms, whereas junior people don't have that as well, and they actually can't operate. In the South African context, we do have problems with data issues, connectivity issues, as well as ESCOM when it comes to load shedding. It's just difficult to operate from home, have backup power, or have not good UPS as well to keep it going for the day. So that's where offices come in. But then the market has to change as well, that the length of the lease is going to change. There's going to be more flexible offices, short, so like 1-2 month leases, or big corporates probably slightly longer, but flexibility is going to be important. And then CapEx requirements required for your mental well-being, health as well, like whether it's air conditioning, piping, space, ventilation as well. All these offices need to be reconfigured, and that's actually big CapEx for landlords, also for actually tenants as well, for their employees to feel safe. Some of our preferred companies in the office market, we're looking at opportunities where the market is actually overly discounted this impact of working from home. Over the US companies on the left, there's Kilroy, they've got like Alexandria, and then Boston Properties, that's a big office landlord in the US. And then Fabergé, that's a Swedish company. Then you've got Colonial, that's in Spain, and then Jacina in France, and then Derwent London in the UK. They've got the best office building, well occupied, and we believe these companies are looking cheap. So global property, just to conclude, if you look at the right-hand side, you can see the impact of the global financial crisis, which was a massive fall, and then the property market recovered. And then COVID-19, as we mentioned, we saw like almost 40% recovery over the last couple of months from the bottoms of March. And we believe there's still lots of opportunities in this market. It's quite small. We're about 5% of the assets, listed assets, compared to the total global property assets, benefits from diversification, from liquidity. On the left-hand side, there's probably more an economic slide. We all probably believe that interest rates are going to be low for longer, inflation lower as well, and that supports the property market. So where we see opportunities is that economic growth, yes, going to be negative in 2020, and then we see a bounce back in 2021. Low inflation, lower funding costs as well do help the property companies as this debt comes up for renewal at lower levels. And supply as well, still a big challenge in most of the developed markets. We just can't build. The location is very key, and the amount of money that's coming to support all these economies is unbelievable and will help to boost the property markets. And these markets are very simple, good corporate governance, good management experience as well, and you've got so many sectors to choose from. As you mentioned, that the sectors that we never talked about 5 years ago when I was presenting, or 2015, when my first presentation at the JSE, we never talked too much about towers, data centers, manufactured housing, and those have been growing quite a lot. And then we still see good growth opportunities in the industrial sector, residential, and self-storage. So that's the global property story. So we still like global property, but we believe that local property has got good opportunities if you're willing to ride through the volatility, and the valuations are just unbelievably cheap. It's just priced the property market as if this company is going to default, and property companies on average are about 20% away from defaulting with the banks in terms of asset values falling. And they've got so many things in place to help run away from that risk of default. But there will be casualties, maybe one or two, and that creates negative headlines. But we believe most of the companies are working towards fixing their balance sheets in challenging times. So that's my story. Simon, over to you.
Keelan, thank you. Folks, if you've got questions, drop them into the Q&A box. We've got a couple coming in. A question has been asked by a couple of the folks is, with interest rates in South Africa having come down, 3% this year, are property companies able to take advantage of that in terms of renegotiating, perhaps getting lower rates on their debt that they have, or were those rates already floating or perhaps long term?
Sure, to a certain extent. So the property sector, they've fixed the debt for on average 3 years, so 2.5 to 3 years. So 80% of the debt is fixed. So the one that benefits from lower interest rates is about 20%. So as debt comes up for renewal, let's say probably 10 to 20% a year or 20% a year, that will benefit as well. So that helps in terms of earnings growth to be not as bad as it seems. So yes, there's a benefit, but 20% immediately, and then the other 20% a year.
Okay, so there's a small bit of benefit. Another question, Terence Hill asking about Into. They're obviously into business rescue out of the UK. My sense is, having looked into it, it looks like the shareholders are probably going to get nothing from the remains of Into when they wind that up. Is that a fair comment?
That's 100% fair. It's unfortunate that they are in the retail space. As we mentioned, that the retail sector is likely to continue to decline in terms of valuations, fundamentals, and then depends what kind of retail. So Intu's retail was dominant 10, 15 years ago, but they never adapted to the changing trends, online shopping, food, beverage, entertainment, younger people as well. So the assets, they needed work actually even before as well. So it's a very sad story, I must say. I remember seeing the assets in 2007 for the first time. They're unbelievable, but now it's basically worth nothing, because the problem is the structure of the and it's very not simple. It's like a spider web in terms of to untangle that. Is unbelievable. I don't know why they got into that complex debt structure.
Yeah. Okay. Jane, you're asking if the presentation will be available. Yep, video will be up in a couple of hours at justonelap.com. We'll have that up there in a moment. Terence also asks, he says on your valuation slide, you didn't have Redefine. Is it a stock you don't like, don't follow, a particular reason about it?
So I did talk about Redefine a bit, that you're just watching the LTV. So Redefine has been doing a couple of things as well. It's just been a very complex business, and they've been working to simplify it. So even before COVID, they were paying out trading profits, you had exposure in Australia, and then student housing, basically everything. So what management has been doing now, and they've been caught with the put structure from all of the South, they've simplified that as well. So it's been going through that simplification process, and the LTV is high. They still need to fix the LTV. They need to sell the assets. They've sold some offshore assets as well. So it's a company as well. We've seen the share price, how volatile it's become as well. And then now it's come down again as well. So at these levels, it's probably more difficult to predict the earnings, but management is working hard. Looking at earnings falling by 45% for their calendar, for the financial, and then we have to look at going forward as well. So there's prospects there as well, but there's high focus risk.
What about a couple of questions? I'm going to put them into one in a sense. I mean, we've got the requirement to pay out their distributions. That 75% of distributable income needs to be paid out. Are there things that we should look out for that companies might try to? The one suggestion is they change their year end. I think probably they're not going to get away with that. Are there some red flags we should be looking in that space, or is it fairly clear cut? Either they're going to do it within the timeline or they miss it, and it will be very apparent.
So it's very clear, actually, I'll say, because the regulation is simple. You have to pay out 75%. Unless you meet your liquidity and solvency requirements, then you probably may not pay. But so that's very clear, unless you can meet those two requirements. And then 75%, and whatever you don't pay out is taxable. And then if you don't do that, then you lose your rate status. And for you to come back again to your rate, it will take you 2 years. And by losing that, it's got tax implications, capital gains implications. So you don't want to be in that kind of position. And the market will be watching out for that. So the market research and corporate governance in the property space has improved a lot. That will be watching for all these changes or potential findings in this market.
And could a rights issue, I mean, obviously, this is not a market to raise capital in, and particularly at the current valuations. But in essence, they could do a rights issue and use that for the distribution, because that rights issue is not distributable income.
So it's a tough one as well. Like that's a challenge with raising equity, because to raise equity when the share price is trading at 60, 70, 80% below NAV. So that would be the last resort, like what you saw with Into and Hammerson as well. So if you see a company raising equity now, it's just to be one, the uptick probably going to be low, and two, then discount the share price on an overly discounted share price already. So that would be quite an extreme last resort measure.
I know Eastern Europe has long been a favorite of yours. Is NEPI still one of the preferred on our local market?
Yes, NEPI is still one of the preferred. So the asset value is falling probably 3%, and then most of the malls, I guess, probably they're moving to winter now. You can see, pick up negative news, but they don't have too much development risk. And the quality of their malls, they're dominant, and they're new as well, so there's capex required, and they've got the latest concept. And from an LTV perspective as well, the LTV is still quite manageable, just below 35%, compared to some of the comparable REITs, which are over 50% in Eastern Europe, like you say.
Okay.
Yeah.
And then what about the granddaddy of our property sector, Growthpoint? I mean, obviously they've got some Australia, they've got some holding some Australia assets, and they've got the V&A waterfront, which is really foreign tourist focused. Growthpoint, it really has. I mean, there was a time when that stock was probably half of the SAPI index.
Yes. So Growthpoint, they've done quite well with offshore diversification, Australia mainly, and then Eastern Europe. UK didn't work out quite well with Capital Regional. We've seen the market asking quite a lot when they went in last year post-Brexit. So timing-wise, didn't work out well. So V&A is still a challenge given the amount of tourists. We're not going to see probably much tourists even in December when most we used to travel from overseas with all the travel restrictions. From a valuation perspective, Growthpoint, we preferred, let's say over Redefine. Valuation saw them fall by about 8.8%, and it's quite diversified with retail, office, industrial, and offshore. So, and in terms of governance and disclosure, we believe they actually stand quite ahead of everybody else, or most of the other REITs.
Yeah, fair point on that. Fortress, folks asking about that. The distinction between the Fortress A and Bs, and I'm going to test my own memory here. If I understand, Fortress A's get a inflation-linked increase in distribution, and then the Bs get the rest of the distribution.
That's right, yes. So in this market favors basically your A units. There's 2 or 3 other REITs with the A and B structure. So your A structure is your bond-like instrument. So the B units benefit in the good times. And we've seen them actually, like even Fortress Bs was flying during good times, and now it's actually underperforming because of the earnings outlook. And actually, this year, the B is not getting a distribution because everything goes to the A's. So we prefer the A units compared to the B units. And what Fortress is looking to do is to actually combine the A and B units and just have as one company. And the challenge is how do you meet the requirements or the demands from the A unit holders who want to get paid a premium, and unit holders have suffered quite a lot as well. So it's an ongoing debate with investors and management, and they haven't come up with a solution yet.
Yeah, okay, I get you. Collapsing that structure is not going to be easy. Here's a great question. So towers, and if folks are thinking, towers, and we're thinking skyscrapers, towers,
Mm.
if I'm correct, towers are the sort of the mobile towers, which take our mobile
Yes, that's right.
telecommunications and the like.
Yes.
Is sort of Elon Musk has got his satellites going into orbit for internet and the like. Does that put some threat into the tower business, or are they very much different? The satellites really more internet rather than terrestrial.
So we were talking about it earlier today, actually. Actually, you'll still need to use the towers as well. So you'll probably have that, but the towers still needs actually to be able to go ahead with that project and deliver on that product. You can't just do it without using the towers. And also like towers, because once you build a tower as well, you can add on actually more providers there as well, because the tower is actually in place already, and
Yeah.
that's additional income, and the capital is done.
Last question coming through. You mentioned self storage. It's certainly it's a sector I know that you've liked for many years. We've got the one example in South Africa, which is storage. Is that an investment that you like locally?
Yes, lockdown has actually helped me open my first storage account, self-storage with them as well. So it just shows that you want to create more space, you're moving, or just to create the study where I am here, some extra stuff, then you take storage. So that's probably one. And then people moving houses, probably downgrading as well. You're seeing that happen, as well as a small business SMEs as well, using that space as well for online or delivery as well. So it's one of our preferred picks. And they've also expanded to the UK as well. So UK,
Yes.
yes, you can see there's Brexit, there's weakness, but that market works in the UK. And self-storage is one of our overweight, storage is one of our overweight positions in the portfolio.
Yeah, I actually just used it as well during lockdown, and it's just such a slick service. I was just like deeply impressed with it. Carl is asking about Hammerson. They obviously just done a giant dilutive rights issue. Post rights issue, are they attractive, or is there a long way back for them?
So we believe they've got a new CEO as well, who comes from private equity space.
Yeah.
Their job is to turn around the businesses, lots of inefficiencies as well, probably cut costs, restructure the business, and look at the pricing as well. They've got the cash now and the valuation at the lowest levels ever. And we believe there's opportunities going forward. That's why we've seen the likes of Resilient as well invest quite heavily in Lighthouse in Hammerson. Because remember, retail isn't totally dead. It's once about liquidity and the capital and the right assets. And at these levels, it's been heavily punished, but we believe at these levels attractive.
Yeah, we saw that Spur update today, which amazed me. They're doing, it's sit down dining, but that's the retail space. And their trading update was very positive. And in fact, Pierre Fontonda said that they are trading well ahead of where they thought they would in terms of occupancies at their restaurants. A question coming through: we don't have, Keelan, if I'm correct, we don't have any tower companies in South Africa. We would be looking offshore for those.
Yeah, it's offshore, unfortunately. So believe over time, maybe over the next 5 years, with this data centers, towers, given the growth in this industry, most of data centers as well, those opportunities could come through to South Africa. We've visited one or two which are privately held, and they still need probably more capacity as well. So there's those opportunities going forward.
Ladies and gents, we will park it there. I'm not seeing any more questions coming through. Appreciate your time for all coming this evening. As I said, video up in a couple of hours on the Just One Lab website. Keelan Ngluvo, thank you very much, sir. Really appreciate your time. Always appreciate your insights. We always leave these events way smarter about property. Thank you very much.
Thanks, Simon, and thanks to the JSE as well.
Pleasure. Cheers all. Have a good evening further.